Hello, students. Welcome back to your economics class. We have completed the chapter Money and Credit, and now today we will do a complete revision. We'll do a complete overview of the entire chapter, a quick, not quick, a nice recap. Let's begin. What is the one thing that will help us meet all our needs? Money. So, without money, we will not be able to fulfill our needs. Money can help us buy a toothbrush, a car, a house, insurance, holidays, so many things. So it buys all goods and services. What do you think must have been before we before we did not have money? Money was of course invented, but what about before money was invented? What was life like? So how did people buy and sell when there was no money? Well, in those days, people just exchanged one commodity for another. This system was called barter system. So let's take an example where one person wants to sell one commodity. Like example, he wants to sell fish, but he has a need for rice. And let's look at the rice seller who wants to sell rice, but he needs shoes. Now let's look at the shoe seller. He wants, he can give his shoes, but he needs a new hammer. Like you can say, they are ready to exchange, but the needs that they have are not coinciding. This so no exchange is possible as their requirements don't match. Exchange of goods requires a double coincidence of wants. That means the fish seller must be ready to give fish and want rice, and the rice seller must want fish in exchange of rice. So money helps us get coming out of this entire situation of double coincidence of wants because money becomes the medium of exchange. The fish seller can sell fishes, the rice seller can sell rice, the shoe seller can sell shoes. They all get money in which they can fulfill their wants and buy whatever they need. So money basically eliminates double coincidence of wants, and money becomes a medium of exchange. Now, before money was introduced, there were different ways of money. These are early forms of money, and these were, materials of our daily lives, and they had a value of their own. Modern forms of money is notes and coins that we are using right now. We all know we are using notes and coins right now, which is the modern form of money. The modern currency is authorized by the national government, and in India, it is guaranteed by the central government, and in India, Reserve Bank of India issues the currency notes and coins. So nobody can refuse the payment in rupees in India. Now let's look at this. Arjun is an employee in a company and he will receive his salary at the end of the month. So at the beginning of every month, he receives his salary. Now, he doesn't want to keep the entire salary with him because he doesn't require that much money. He's worried for the safety of the extra cash. What will he do with the extra cash? So Arjun is worried what to do with this extra cash because I don't require so much amount. So he decides to deposit the extra cash in the bank. He is a customer of ABX Bank. You all need a bank account with that bank to deposit. So he has a bank account with ABX Bank. He goes and he deposits the money. The bank accepts the money and adds it to his account, to the account holder's deposit. Now, the bank will not only pay the money back when Arjun requires, but they will also pay an interest on the deposit that he's made. So it is a win-win situation. It's a win situation for Arjun. Money can be withdrawn from the bank whenever he wants. So it is also called demand deposit, since he can withdraw it at his own convenience. Arjun then visited a nice TV showroom to buy TV, but he does not have the cash to buy TV. Now, mind you, he does not have the cash at the moment. It's not that he cannot afford it. It's not that he has no cash at all. It's only the circumstance as if now he does not have the cash. So, what can he do? Well, nowadays, most of the showrooms give us lots of options. We can pay using check, cash, debit card, credit card. So, he can use any of these mediums to pay. This particular, the medium that Arjun will choose will be check. In check, what is a check? Basically, a check is a paper instructing the bank to pay a specific amount from the person's account to another person in whose name the check has been issued. A bank, a check normally has all the things on it. It has the bank account name, it has the amount specified, it has, it has a magnetic name of the person to whom the check is made, amount in words and amount in figures, instruction to transfer the amount only to the pay's account, and of course the signature of the account holder, the account number. All these things are mentioned on the check. Now, check is a very good form of transaction, but nowadays we also have plastic money. Plastic monies is debit cards and credit cards. A check also represents the money just like cash in a bank deposit. Now, why do you think the bank gives loans? Why would the bank give a loan to somebody? Look at the entire working over here. A person like Arjun or you and me, we deposit money inside the bank. And what does the bank do? Bank will keep only 15% of that money with himself. This 15% is called cash reserve ratio. So 15% of the deposit money is kept with the bank, and the rest he is allowed to loan others and use as credit. Can you find out what is the cash reserve ratio right now? And has this pandemic affected it in any way? This cash reserve ratio is constantly adjusted because depending on the country's economy, it's constantly adjusted. Now, this cash deposit ratio, 15% of deposits that the depositors make is kept with the bank so that if any depositor comes to withdraw money, the bank has it. Because not every day, everyone who's deposited money will go to withdraw. So, depending on the country's economic condition, the cash reserve ratio is normally changed. So, what is the cash reserve ratio today? And has the pandemic made any changes to it? You should find out that for yourself. Now, CRR, or cash reserve ratio. CRR is the short form for cash reserve ratio. Now, major portion of the deposit, that is 85% of the deposits that people make to the bank, is used to give loans to people. This is exactly how credit is given. How urban area we have more credit than the rural area. So now, when the bank is giving loans, what does it gain? Well, we are giving money to the bank. We are depositing money to the bank. The bank is keeping 15% of that money and forwarding 85% of it is used as credit or loans to others. So there are two types of people. There are depositors and there are borrowers. What do the borrowers do? They borrow money from the bank and they pay back with interest to the bank. And what does the bank do? Bank takes as money, take our money, so we deposit money in the bank and we withdraw it from the bank with an interest amount. So what does the bank gain in this entire process? Well, the interest that is charged on loans is definitely more than the interest that they pay us as depositors. So if I deposit a money, I'm going to deposit some amount in the bank, I am definitely going to earn 4 to 5%. But if I take loan from the bank, I have to pay back 8 to 9%. The difference between this, that is the interest charged on loans and the interest paid on deposits, is the profit that the bank is making. It becomes the income of that bank. So this is how the bank earns income. So this is the income of the bank. That is the difference between these, the interest on loans and interest on deposits. Now this loan that the bank gives is also called as credit, loan or credit. To take loan from a bank, we must agree to the terms of credit. Now terms of credit can be different for different banks. The rate of interest may differ. While some banks may give us 9%, some may give us 5%. So basically, the borrower has to pay an interest on the credit amount. Like I told you, we will repay back the money to the bank with an interest amount. Now, besides paying an interest amount, the borrower must also offer some security against the loan. Some way that if the borrower fails to return the money, the bank needs some security or a surety that their money is safe. This is called as the collateral. Collateral is basically an asset. It can be a land or property. It could be a vehicle. It could be livestock. It could be standing crops, or they could also be bank deposits. All of these work with the bank. Now, sometimes, so these are the collaterals that sometimes the bank needs to sell in case of non-repayment. That means the lender, that is the bank, can sell the collateral to recover the loan given. And this way, a bank is always safe. The borrower often also needs to submit lots of documents to avail loan, like identity proof, residence proof, employment certificate, income certificate, salary slip, etc. All these help the bank to decide if we should give the loan or not. Also, duration of the loan is already fixed. It's pre-decided when the loan must be repaid completely. Loan can be repaid either in cash or in check or in card form. All these three forms are absolutely fine. But you must repay the loan before the due date. Now, now, many people take loan and all of them take loan for the same reason? No, take loan for different reasons. But does loan benefit everyone? Does credit benefit everyone? Now let's look at these two people. They both want to take loans from the bank, but for different reasons. One wants to open a poultry farm, while the other wants to open a dairy. They both will take the loan, and of course, the interest rate, that is terms of credit, will be same for both. Now, when, let's give him a name, Mr. Sam, when he took the loan to make a dairy farm, he was very lucky because the demand for milk was very high. He made great profits and he was able to repay the loan immediately. But is this the same case with everyone? Let's look at Peter. He opened a poultry farm, but unfortunately for him, the business did not do well because of bird flu. Now he's in a loss condition and he, he's finding and he's struggling to find methods to repay his loan back. Sometimes we have to sell our assets to repay the loans. So while for Sam, taking a loan was a good idea and his dairy business started to bloom, for Peter, taking a loan was a bad idea and his poultry farm closed and he still has to repay his loan. If you need money on credit, where should you get it from? Well, in the urban areas, we can get it from the banks or cooperatives, or we can go to the informal methods and go to our friends or relatives and borrow money from them. We can also go to money lenders and traders, which are mainly found in the rural areas, or landlords, which are again found in the rural areas. Now, this is a graph which shows different sources of credit used by people in the rural area. So, in the rural area, people have different sources of credit. 25% use banks, 27% of them use cooperatives. This is the formal sector. In the informal sector, 1% go to landlords, 30% go to money lenders, 3% go to traders, 7% borrow from relatives and friends, and other sources are used in 7%. These are the informal sources. What is the difference between formal and informal? We learn very soon. You have already learned, we'll see very soon. This is the informal sector of credit. Now, the difference between these, while the formal sector of credit is 48%, the informal sector is 52%. We must increase the formal sector so that everyone benefits from it. What is the difference between formal and informal sectors of credit? Well, in the formal sector of credit, we have a supervising authority. We have a supervising institution like RBI. But in informal sector, there is nobody to look. There's no supervisory body. There's nobody to look at the terms of credit. The formal sector will treat all borrowers equally, whereas the informal sector will not treat all its borrowers equally. The terms of credit may differ from one person to another. Formal sector is only driven by profit. So wherever they see more profit, it's going to go there. Now, what about the interest rates? The interest rates are much higher in the informal sector than the formal sector. So, if you look at a high interest rate means less money for the borrower. That means he has to spend more money on the loan and less money as income. High interest rate, sometimes the loan repayment may become more than the income and also will fall into a debt trap because he's not earning enough, but he has to repay more. Look at this chart of the urban sector, the credit sources of the urban sector. This is divided into four parts that are rich households, well-off households, households with few assets, and the poor households. You can see a very clear difference between rich households and poor households. While 90% of rich households take their credit from formal sector, around 15% only can take from formal sector and 85% take from informal sector. Now, clearly, the rich people are giving less interest on the amount. They have access to cheaper loans from the formal sector, whereas the poor households are dependent on expensive loans from the informal sector. We must change this, and cheaper credit is very, very essential for the development in an economy. So, how can we change this? How can we make sure that the lending from formal sector increases and informal sector decreases? Because most of the time The people in rural areas, poor households, they depend only on the informal sector for credit. How do you attract them towards the formal sector? There are so many people. The reasons that they are not going to the formal sectors is very simple. There are so many villages that don't even have a bank yet. If you ask, or if they have a bank, they do not have collateral. If they do not have a collateral, no bank will lend them money. But for a money lender, he knows the person personally. He does not need a collateral. But what does he do? He gives his terms of credit are very, very mean and difficult. And also, since there is no supervisory body, he can change them anytime he wants. Here, he is charging him 60% interest and labor in his field. And the poor farmer has no choice but to accept. Another way out of this is if we make them into a group that helps themselves. What if we make them into a self help group? A self help group is basically a combination of 4 to 5 people, 15 to 20 people who pool in their resources together and they make a saving, and then they give loan together. They create a savings pool, and the members of that particular self help group can borrow some amount, can take a loan from that savings, and of course, repay the loan back with an interest amount. And the rate of interest over here is much lesser than the money lender. After a few years, the self help group is also eligible for a bank loan, and that too without a collateral. So, this is another way in which we can attract the rural area people to the formal sector. Now, different people need loans for different reasons. And over here, all the members of the self help group must decide together who gets the loan and at what rate. Now, bank loan, once they can take the loan from the bank after a few years, this loan is used to generate income and employment opportunities for the group. Once, and the reason the bank gives them the money without any collateral is because a self help group takes joint responsibilities and joint decisions. Each and every member is involved in the decision making process. Bank also gives loan to women self help groups, and so women can become self reliant, financially independent, and socially aware. We, as the youth of the country, must spread this information and let the rural people know how they can benefit from such wonderful options, facilities that our government provides. The self help group are definitely the way we can increase the lendings from the formal sector. The classic example, self help groups means access to affordable and easy credit. The best example of a self help group, the most successful one is the Grameen Bank of Bangladesh, where they gave affordable credit to the poor people. Basically, it was a banking for the poor. It was founded by Professor Muhammad Yunus, who is the founder of the Grameen Bank in 1970. At the moment, there are 6 million borrowers in 40,000 villages, and women are the majority of followers today. So there's this really good quote by Professor Muhammad Yunus. He says that if credit can be made available to the poor people on the terms and conditions that are appropriate and reasonable, these millions and millions of small people with their millions of small pursuits can add up to create the biggest development wonder. So I think this is a very beautiful thought. And like I had told you all last time, Seva Neha. These are also Indian self-help groups, but most of these are related to women. So if this interests you, this topic interests you, you can find out about a self-help group that is not only for women, but for the poor. With this, I end today's class. Stay home, stay safe. I hope this revision was good for you. You all should be more prepared for the examination now. Stay home, stay safe, take care, keep learning. Thank you.